personally, I hope that gold falls another 500 to $1,000 an ounce, because then I would increase my gold position again rather substantially. I think that in a major bust, gold and silver and platinum will go down also, but they will go down by maybe 30%, and many other things will go down to zero, and many other things will go down 98%. Say all stocks related to the Trump family will go to zero. That is my prediction.
Global markets are entering a dangerous phase, with liquidity tightening, weakening asset prices, and investors underestimating the risks ahead. Marc Faber, a veteran contrarian investor known for his long-term macro views, warns that the same forces that lifted assets for more than 4 decades may now be reversing. He explains that since interest rates peaked in 1981, central bank money printing and currency depreciation have pushed real estate, stocks, commodities, Bitcoin, and precious metals higher. But now, commercial property, crypto, and residential real estate are already showing major cracks. Some assets are down 70 to 80%, while certain property portfolios have lost more than half their value. His warning is clear. In a major bust, gold, silver, and platinum could also fall by around 30%. But many speculative assets could fall by 98%, or even go to zero. For long-term investors, precious metals remain a safer store of value amid deficits, debt, and future money printing. Now, we present the clips from Marc Faber's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
The public or the investing crowd is believing that cash is trash and that you have to hedge your assets or your money with assets such as real estate and stocks and precious metals and other commodities, energy, and so forth and so on. And I think that we have been in a bull market for asset prices already for more than 40 years. In fact, actually since 1981, when interest rates peaked, asset prices have gone up a lot because of money printing by all central banks around the world and the general loss of purchasing power of paper money. That is correct. At the present time, it is possible that liquidity is somewhat tightening because in general, people believe, and economists will tell you, liquidity drives markets. In other words, it drives up bitcoins and it drives up micron technology and whatever. But it is also possible, or probably likely, that when asset markets decline, that liquidity tightens. I mean, we've seen now 2 major asset classes that have declined meaningfully in price in the last few years. And this is commercial properties. Commercial properties, I just read a company, they sold their property portfolio or holding in Seattle for half, actually less than half of what they paid in 2018. And that has tightened liquidity for some people who were large holder of real estate in a leveraged way. And then we have the decline in cryptocurrencies that has surprised many people because they were all betting on Bitcoin and everything going up. And now these cryptos, in some cases, are down 70, 80% from the peak. So that has tightened liquidity for Generation Z because the cryptos were bought like crazy by young people who didn't want to own any gold, silver, and platinum. They wanted something that moves more than the traditional safe assets such as precious metals. And that has tightened liquidity of young people. And more recently, over the last, say, 18 months, residential property prices have gone down, especially condo prices. And a lot of not wealthy people, but middle class people were long condos, partly to have a second home in Miami or so, but also partly as an investment. And so I think that liquidity is sort of tightening, and it will be interesting to see today. As an example, the Dow is up strongly, but the six most active stocks are all down on the day because they're technology related. And the SOX index is down about 3%, whereas the Dow Jones is up strongly. So we have changes in the composition of assets that are meaningful. I like precious metals for the simple reason that I'm not so smart to choose the right thing at the right time every year or every half year. I like precious metals because I think that in the current environment, especially if I look at the Trump administration, I want to have something relatively safe and that is thriving and keep its value in an environment where the government will spend money like water. They're not going to reduce the deficit. The deficit will go up. And since the interest payments on the debt will therefore also go up, more money printing is only a question of time. Personally, I hope that gold falls another 500 to $1,000 an ounce because then I would increase my gold position again rather substantially. I have a substantial position already, uh, more than most people would have, except the gold bugs like Eric Sprott. He has most of his assets are in gold, or some other people I know, they have most of their assets in gold. But most people that I know in the investment world, say among fund managers, most fund managers do not have more than 1% in gold. And already a 5% involvement in gold is a lot. I know rich people in Switzerland, they have most of their assets in real estate, in some stock portfolio, in some bond portfolio, private equity, and gold maybe, a few ounces, which they inherited from their grandmother, which bought them during World War II. Ordinary people should save some money. They have to lower the cost of living somewhat. And then with their savings, they shouldn't hold it in a bank at very low interest rates. They should actually buy precious metals every month of the year for the next 50 years. A little bit of gold every month. And then they will have an average price that is very attractive in the long run. This is my view. But the generation Z, they will tell you we're going to buy a year ago Tesla and Nvidia, and now Micron Technology and AMD and so forth, and 3 years ago AMF and GameStop, and before that the cannabis stocks, all stocks that went up like a rocket and then they fell down by 98%. In a mad world, uh, what is relatively less mad, it may be appearing attractive, but if the mad world collapses and we have a major financial bust, then also what is relatively low will go down. Whatever you consider, at the end, I think that in a major bust, gold and silver and platinum will go down also, but they will go down by maybe 30%. Many other things will go down to zero, and many other things will go down 98%. Say all stocks related to the Trump family will go to zero. That is my prediction with
Well,
a
this
relatively high confidence.
The key point is not that gold will move in a straight line. In fact, Marc Faber says he would welcome another $500 to $1,000 decline in gold because it would allow him to increase his position substantially. That is an important distinction. Short-term weakness does not destroy the long-term case. He believes governments will keep spending aggressively, deficits will rise, and interest payments on debt will keep increasing. That makes more money. Printing is only a matter of time. At the same time, speculation in precious metals remains surprisingly low compared with Bitcoin, Solana, tech stocks, and other popular trades. This is why gold, silver, and platinum still matter. They may correct during a liquidity squeeze, but they remain one of the few assets that can preserve value when paper money loses purchasing power. Let's get back to the interview.
I've experienced so many bubbles, and I always distinguish. There are small bubbles that, when they burst, do not cause significant economic damage. But big bubbles like the South Sea stock in 1720 in England, when it burst, it caused significant damage. Or in the 19th century, we didn't have central banks, so the bubbles were large, but they were not as large as they are today. When they burst, the railroad bubble burst, or one of them. I mean, they had many railroad cycles in the 19th century because railroad construction and canal construction were the big capital spending objects at the time. The biggest railroad bubble burst in 1873 after the Civil War. And by 1895, 95% of railroads were in receivership or bankrupt. And the interesting thing about the AI bubble that I need to mention, in America and elsewhere in the world, canals were a huge thing because they facilitated the transport of wheat, corn, soybeans in large quantities on ships, on canals going from river to river. And the most successful canal that was ever built in America, the Erie Canal, also went bust. And I just like to mention that in England and in Holland, the Dutch East India Company also went bust eventually after having been a very successful enterprise. So I think the AI bubble, and it is a bubble, except I cannot tell you, has the bubble burst yesterday or today, or will it burst in 6 months' time? And some stocks, the market is a composition of many different stocks. So in theory, you could have one stock going up vertically and pushing up the index, and 499 stocks in the S&P not going up. The recent rise of the market this year, I'm to say, is very poor in the sense that 45% of stocks are below the 200-day moving average. There's only a handful of stocks that is making new highs. The new high list is very limited. I think that two things. I mean, I remember in the late 1990s, and when people ask me about how successful have you been as an investor, I say, I made one major mistake in my life as an investor, and this is I shorted the Nasdaq bubble in 1997, 98, and it still doubled. And I covered then at the end of 1999 at the wrong time, but it still went up 30% between the end of 99 and March 21, 2000. 30%, the index in 3 months before it broke. And it broke down then more than 70%. Or Japan, I also shorted it in 1988, and it went up to the end of 1989, and then it broke down by more than 70%. So I have now essentially given up being short, but I'm worried that this is the biggest mistake I'm making nowadays, not to be short the markets. For a commodity that has performed as well as gold, say when I started to work in 1970, gold was $35 an ounce, and now it's 4,500 whatnot. I mean, it's performed well over the long term, and it's performed very well over the last 12 months, 18 months, and there's no excessive speculation. The inflows into ETFs have just recently picked up, but then with the correction, they've again
Yeah.
sold. I mean, considering the performance of gold, silver, and platinum over the last 18 months, there has been remarkably little speculation. I go out to bars at night and people play pool, and they have people that are involved in sports betting and all sorts of investment schemes that are scams or dubious. I tell you, you hardly ever l- hear of anyone buying or selling gold. Hardly
Yeah.
ever. They buy and they're all active in bitcoins and in Solana and whatnot. But gold and silver and platinum, it's a, I tell you, of all the people I know, only maybe five are active in precious metals.
Interesting.
I'm not particularly active because I just hold gold, period. I, I don't sell gold. I've sold some of my gold shares because they had huge run ups. And I'm of two minds about gold shares. I think if you want to make money, you can make money, a lot of money in gold shares if you buy them at the right time. My view is that everything is in danger zone. You know, when I grew up in the 50s, my grandmothers and grandparents said you have to save 10% of your income and put it on deposit with a bank. Well, that advice was a disastrous advice over time because of the depreciating currency, the loss of purchasing power of paper money. They should have said, Mark, you stupid young boy, buy every day some stocks or buy every day some gold and so forth. And don't put it with a bank on deposit. But interestingly, nowadays, if I look at the asset allocation of people, the cash position of investors is at one of the lowest points in history. And it tells me that maybe, and the asset that nobody wants are treasury bonds, long term treasuries. So it tells me if we go into recession and the recessionary forces are much stronger than what people expect, because if asset prices decline, it may affect consumption meaningfully. And if that happens, maybe cash and bonds is not such a stupid allocation for the next 6 months or 1 year. You understand? It's not a long term proposition, it's just a strategic opportunity. And I am cautious of increasing my stock position. I have a large portfolio of stocks in Thailand because the Thai stock market is one of the few stock markets that has gone down for the last 5 years.
The deeper concern is that investors may be holding too little cash at exactly the wrong time. Marc Faber points out that cash positions are near historic lows, while almost everyone believes cash is trash. But if recessionary forces are stronger than expected and falling asset prices begin to hurt consumer spending, then cash and long-term treasury bonds could be useful for 6 months to 1 year. This is not a long-term endorsement of paper money. It is a tactical warning. In a market bust, liquidity becomes valuable. Investors who are fully exposed to stocks, real estate, crypto, or speculative assets may be forced to sell at the worst possible time. Faber remains cautious about increasing stock exposure, especially after years of inflated asset prices. His message is that gold has already performed extremely well over the long term, rising from $35 an ounce decades ago to thousands of dollars today, yet public participation in precious metals is still limited. That may be the most important signal. When everyone chases momentum, safety becomes unpopular. But unpopular assets often become essential when the cycle turns. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.